this, our quarterly Guide to Alternatives webcast. I'm James Burdis. I look after global strategic clients and private wealth alternatives across Asia Pacific, and I'm really glad to be joined by our resident alts expert, our market strategist based in Melbourne, Kerry Craig. Kerry, good morning to you. How are you?
Morning, James. Thanks for being here.
Good to have you on the call. So this morning, we've got a really exciting agenda lined up. We're going to be going through the role of alternatives in a portfolio, a number of asset class questions that are on investors' minds right now. But before we dive into the agenda proper, we want to really thank you all for taking the time to join us this morning, our clients and partners from around the region. We really do appreciate your support for these webcasts. This call in particular comes at a really interesting time for the alternatives asset class, with the traditional 60-40 under pressure as we speak and volatility climbing, correlations turning positive across traditional assets. There's perhaps not a better time for investors to be thinking about utilizing alts for the first time or adding to their allocation. So we're going to cover off the role of alts in a portfolio, but also the individual constituent parts that make up the sub-asset classes of alts. So without any further ado, let us turn, Kerry, to today's agenda. We're going to start by just picking the argument up around the role of alts in a portfolio. So I alluded to the fact that traditional portfolios, the 60-40 as we think about it in a traditional sense, have quite often at certain times offered a diversification advantage, the free lunch of investing, some might have called for it. But with volatility spiking, with inflation rising, and with the traditional correlations that are negative in traditional sense, now turning somewhat positive, we're now in a position where we have to look at the extended tools of a portfolio, and one of which of those, I think, which is really important at this moment in time to consider, is alternatives. Just thinking about how widely alternatives are used at this point in time. So with ultra high net worth investors and institutional allocators, we see a traditional portfolio now holding around about 20 to 22% of alts in the institutional space. What is a little bit further behind is in the high net worth and mass affluent space, which we see being around 4% of portfolios today. So clearly, there is a long way to go, both in terms of educating the need and the use case of alts, but also the fact that alternatives can bring different things to portfolios across what we think of as the AID effect: alpha, income, and potentially diversification. So just thinking about those different roles that alternatives can play, Kerry, let me turn quickly to you. When we think about the macro backdrop that we're now faced with, what role do you see alternatives playing in the modern 60-40 portfolio?
Thanks, James. I mean, an excellent place to start. And again, I add my appreciation for everyone taking the time to join the call this morning as we walk through the new slides from our Guide to Alternatives that was released just this week. I mean, when it comes to that 60-40 portfolio, I think the starting point is to recognize that it's actually worked very well for the last few years. So you look at the chart on the left, the 60-40 portfolio, this is US stocks and bonds. You've had 3 years of very good returns there. This year, a little bit more challenging, obviously, for known reasons. We've got valuation concerns at the start of the year. There was concerns around AI disruption, what that meant for certain parts of the market, and obviously private credit, which we'll talk about later. And then obviously more recently, what's happening in the Middle East. And that's more concerning because you're getting that shift of what at the start of the year was a pretty good outlook for growth. Expectations around fading inflation is now sort of a view of, well, there's these big headwinds to growth. There's these rising expectations for inflation. And so you've seen bond yields move up quite aggressively. And even though you've seen equity markets hit all-time highs in some markets, it's been relatively narrow. And so you might argue, well, actually that correlation between stocks and bonds is doing the right thing at the moment. But I think I'd point to the chart on the right and say there's a lot of volatility when it comes to looking at these correlations in the relatively short term. So that chart on the right shows the correlation between stocks and bonds over a rolling 12-month period. But it's more around that regime shift that we're seeing, those green lines that run through that, and the fact that we've moved from what we would consider a relatively low inflation regime, where you had central banks that had a challenge to create the inflation to meet their targets. You had low levels of growth to one now where you've got these bigger divergences around the world, whether it's this geopolitical element, the energy premium that we might see being built into oil prices that add to inflation, the shift away from sort of globalization, all these forces which add up to a little bit more inflation out there does suggest that we get that higher base level for inflation, and that does challenge that stock bond correlation. So it's not necessarily the volatility in that on any given day, it's the fact that we think we're entering into this new regime, which is very different to where we have been in the past. And most of the clients we talk to are very much aware of what happened in 2022, that fact that bonds and stocks worked in the same direction relatively to being offsetting to each other, and wanting to avoid that overall, as well as take advantage of some of these big themes that we see manifesting in the markets, whether it's AI, whether it's energy, and how to play that through a private market, as well as thinking about the public market side. And I think it's important to recognize, and the stats that you outlined there at the start, James, around that allocation size to this alternative assets and that acronym around AID. Obviously, we're thinking about the benefits of alternatives in terms of adding to the growth in your portfolio, generating income, and building in that diversification. And that focus on which one of those things you want really dictates what asset class within the private markets you go to. But some assets include both. Some give diversification, some provide growth and diversification. I think the reality is, as we all look for a better risk-adjusted return in our portfolio, we all think about how we want to achieve those longer-term objectives. We need to have more of those alternatives. So in the past, we've written about the essential nature of alternatives from one that was optional, really becoming more developed and more embedded in how we think about portfolios. So this chart, and this is for illustration purposes, so not anyone's portfolio, but just demonstrates how that movement from a 60-40 portfolio there in the middle of the page, just that adding of a 10% equity allocation, a 10% allocation to alternatives, and a very diverse allocation to alternatives, can lift that return, lower that volatility, and obviously generate a better risk-adjusted return. So whether it's if you're someone who's coming from having no allocation to alternatives, if you're on that sort of high net worth 4% allocation, or even if you're further up the scale in terms of the ultra high net worth, there's still a benefit to thinking about what is the right size of that allocation in a portfolio to help deliver on some of those objectives that perhaps are a little bit harder to find in the public markets, or thinking about how we play some of these same themes we like in the public markets through the private market alternative sphere in terms of what that can do to enhancing that return, that diversification, that income, James.
Yeah, just picking up on what you were saying there really is no alternative to alternatives now. And I think the ability to access alternatives has probably never been greater than now. So we're trying to use Guide to Alternatives with slides such as these to help investors across the continuum of wealth understand the use cases. And thinking about the use cases, one of the misdemeanors I think that I've heard of quite often is alts is one thing. Alts is one asset class. It's all bucketed together. We think differently here at JP Morgan, and we think that different sub-asset classes can offer different things within the alternative sphere and behave differently within and among themselves. So the role of private equity and private credit may offer one thing. The role of hedge funds and infrastructure may play a very different role, linking back to what you said about alpha, income, and diversification. So it's really important to pick apart the sub-asset classes of alts. And let's just start, if we may, Kerry, on private equity, because private equity is more widely known and understood, I think, by investors today. So it makes sense to start there. But what probably is less well known is the use case for private equity. Now, just take this fact into mind. Out of the 21,000 companies in the US that generate $100 million in revenues today, 86% of them are private. Companies are staying private for longer than they ever had. So there are clearly advantages to doing so. But the point I'm making, still linking back to the role of alts in a portfolio, is that if you're going to fish in the biggest pond possible, you want to make sure that private equity is in your kind of sphere of the universe rather than outside as you think about allocating to equities as a whole. So thinking about private markets then, and private equity in particular, the opportunity set, simply put, is 6 times larger than public markets. With investors increasingly focusing on the asset class, though, I think it's really important to think about which pockets of private equity make most sense. We have a particular eye on secondaries, just thinking about mitigating the J-curve effect, improving diversification, and just gaining access across that vintage scale with transparency as well. So question to you, Kerry, is thinking about the IPO market being muted for the past few years and the fact that exits have been a little bit more challenged. Do we expect that to change this year? And where are the pockets of opportunity in particular that you see within private equity?
Yeah, I mean, it's one of these things at the start of every year, everyone puts out their year ahead notes, or we have our alts outlook for the start of the year. The setup for thinking about activity in terms of exits and M&A and IPOs were very positive. I mean, and they have been so far. So if we look at the data that we've got so far in terms of the global outlook for M&A and IPOs through the first quarter of the year, the grey bar, the very last grey bar in the charts on the left and right show you the first quarter numbers. You can see that that is much higher than prior years for first quarter. So there's been a really strong first quarter in terms of the activity, both on M&A and IPOs. And why is that important? It's important for private equity because it means there's exits, that if you're an LP or GP, you can see a way to actually move these portfolio companies on to generate those returns, to have those distributions that have been missing from the market. But there's also an element of concentration here. So a lot of this is a very large end of town. And we do know that there is, in the pipeline, what could be the most significant year for IPOs and exits from a lot of these very large companies that are coming to the fore. But again, it's relatively concentrated in terms of that. So there's definitely a concept here and a consideration around the size of the companies that do go to the public market in terms of thinking about their attractiveness, and also recognition that those companies are very big for a reason. They got very big when they were held private. So as we look forward in terms of thinking about when we get the second quarter numbers, maybe they won't be so good because clearly the market was disrupted across the April and into May. And so we see and I should say our base case is a reopening of the Strait of Hormuz. We should see, the economy and market recover over the second half of the year on a more broader base, away from just thinking about the AI, a theme that we've seen driving equity returns. And so this should allow for a bit of activity in the second half of the year when it comes to these very large exit opportunities coming in. And I would go back to that point that you've made, James, around the fact that these companies are staying private for longer and they get much bigger. So to your point exactly, the chart on the right just shows you that dominance by public markets into private markets in terms of companies that are in there over 100 million. The bottom left-hand chart shows you that extension when it comes to thinking about the average market value of these companies when they go to public markets, and just how much that purple line has shot up, as well as thinking about the age of those companies being much longer. And this has all become it's always been because there is just more money in the private markets to fund these companies. So there's been that growth in the ability to actually stay private for longer because there's plenty of capital being allocated to allow that growth to happen. So for investors, and the implications of this is that if you wait until these companies go private, perhaps you're missing out on a lot of that growth potential that's already come through in terms of what it comes. And then you're also a little bit suspect to the performance of those companies when they do go public. So we have another chart in the guide to alternatives that you could look at, which just shows the experience by vintage years of companies after their IPO. Unfortunately, for the 2020 to 2024 vintages, it's not a great experience. On average, they're down about 26%. And so you are a little bit more subject to that. So if the opportunity in a lot of these companies, especially around the tech and AI theme, is when they're small and growing and becoming before they go public, this is really what we're going to focus on in terms of delivering that alpha, delivering that growth that people have typically gone to the equity market to find, and perhaps are a little bit more challenged, whether it's around the valuations of these companies or thinking about the volatility they then get when they're subject to the public markets overall. But staying private for longer, getting bigger before they go there, again, is a theme that's coming through. And I think that dominance around the tech side of things with these expectations of IPOs is something we, again, look to and towards the private market in terms of the opportunity that's really there. And I've sort of moved down the sort of structure a little bit and thinking about VC. I know that's a little bit different to private equity in terms of where we are, but I think it really hones in on the fact that as this sort of AI theme becomes even more dominant when we talk about how things are happening in the market, the amount of money that's being allocated to grow these things, the change in the way we're seeing it being developed from learning and LLM models to one that's much more agentic and a lot more inference and demand that's compute power that's coming through, it is feeding into thinking about where the next beneficiaries or the companies that will really have an impact in the future around what these models look like. And often these are the smaller private companies that are doing the most work in this space. And so the chart on the left-hand side just shows you for North America, we're taking this data from PitchBook, that you can see the deal value and how much is split between AI and non-AI. And it really is an AI story that's really driving this. And so if you think about that secular theme that is being played through in the private markets, or public markets, excuse me, it's becoming much more prevalent in the private markets. We see them having a heavier weight to this whole tech story. And the size of those deals are getting much larger as well. So the right-hand chart just shows you by the category in terms of thinking about those sector-specific applications or the large language models, just the deal value size, $100 billion for these things is significantly higher. And in fact, even in those sector-specific, model-specific categories, you're actually seeing them scale very quickly and getting up to higher levels of revenue very fast, which is different to how we would typically think about VC, a couple of decades ago in terms of their potential for revenue growth and what they actually delivered. So these are things that, were deemed to be a lot more speculative in the past, but are becoming a lot more apparent in their ability to drive growth alpha, revenues and earnings at an earlier stage, which we think is very attractive and actually naturally flows through in terms of thinking about, VC to growth equity to thinking about private equity companies overall. So that is quite a positive setup for private equity. It is a lot around capturing a lot of the AI theme, the developments we see coming through there, but there's also this recognition that if a lot of the activity is happening at the larger end of town, that usually means a lot more leverage being involved. One of the macro dynamics at the moment is obviously around if there is more inflation, what does that mean for central banks? What does that mean for interest rates? What does that mean for funding costs on these deals when we think about what actually transpires overall? So I think there's a difference here between thinking about the very large deals. We have a lot of leverage in how that's financed versus some of the other parts of the market, say smaller and middle market, which may have less leverage and less affected by this. So when it comes to the private equity side of deal financing, if we look at the spreads for LBO deals, you can see this data only runs through 2025, but it captures this theme between private equity and private credit, where you had private credit increasing in size, and one of the drivers of that market was obviously to finance a lot of the private equity deals. If you look at that grey portion of that left-hand bar, that is that new issuance of private credit LBO financing that came in at less than 500 basis points. So simply the demand that was there and the amount of money that was going to private credit made it more appealing to finance a lot of these deals. So that's probably still working its way through the system in terms of that. Certainly or if cash rates start to go up or at least don't fall, that can weigh on anything that has more leverage in it in terms of those deals that come through. But for now, it does seem like when we're seeing this financing come through from the private credit side, that is still a source of that funding coming over. But it does also skew us to say, maybe the opportunity is more in that middle market side of things where there isn't that same risk or same exposure to thinking about leverage. And that really does, again, come back to your points around secondaries, James, and how we approach the market and thinking about that opportunity set there. Because while there's that exit opportunity when you go to the very large end of town and they go out to the public markets, there's still that drive for distributions. So one of the charts, it's not on the deck today, but you can look at it in the Guide to Alternatives, does show that those distribution levels on average are actually still very low. And we know that GPs and LPs, they want to have that capital repaid. They're looking for that distribution as they roll into new deals. And so they're looking for other ways to exit the market. And this really has embedded itself in the growth in the secondary market. And so on the left-hand side of the page, you can see last year just the size of that growth in terms of both GP and LP-led secondaries that really was driving that movement towards a growing secondary market to drive those distributions and also create that additional exit opportunity for GPs and LPs to have that. Now, pricing, again, is something to be aware of. And so on the right-hand side, you can just see the different pricing across buyout, credit, venture, and real estate. But you're still, on aggregate here, getting an 8% discount to NAV. And I think that as we've seen that pricing evolve, it was shrinking a little bit. That was perhaps, the hesitancy of some holders of older portfolio companies wanting to not crystallize losses, not wanting to sell, changing that view as they see the market. And you get that, shrinking bid spread shrinking spread between bids and asks really that allows those deals to actually happen and make the market a little bit more dynamic overall. So in terms of the opportunities and how we see things going, I think obviously the very large end, what we're seeing in the public market is very interesting. A lot more of it's probably happening in the smaller part of the markets in terms of the mid-market, given there's some concerns around what rates may do in leverage, looking for that still demand through distributions and the exit activity, and potentially relatively better pricing when we look at some of these discounts overall, James.
Yep. So I think being active is clearly an important skill within long-only investing. It's crucial within alternatives, particularly, fishing for the best opportunities within a pretty vast universe, as I alluded to earlier. I really think secondaries in particular is one area where value can be added with research and fundamental research on companies and slugs of funds that need to be readdressed, reevaluated with a different valuation, and potentially repurposed into strategies that may offer you opportunities to extend your alpha. That's the ultimate argument with private equity. It's that with the AID analogy, private equity can be one of those tools to help you generate alpha over and above public markets. Now, thinking about private credit, because you alluded to it a couple of times there, Kerry, throughout your last bit. Private credit has got some headlights and some spotlights recently, not least because of the headlines that have been written for specifics around the liquidity provisions and vehicles in particular, and the build of those vehicles has become a particularly important topic of headlines and consideration. Now, as we think about private credit as the asset class, we like to think about the role it plays within alternative portfolios and broader portfolios. And this is one way you could potentially look at the role of diversification of income streams. So it's one that wealth management investors, mass affluent investors, or ultra high net worth investors alike can seek potential benefit from. But there are some headlines around the stresses of the asset class right now. We as a house think in particular that these risks are not systemic at this point in time, perhaps more idiosyncratic than systemic, potential areas of stress within certain sectors. Obviously, AI disruption, so therefore the software piece within the tech space has had a lot of attention recently within private credit. But our view more fundamentally is that the asset class as a whole is still in its relative infancy, and this represents the maturation of the asset class as a whole, as some particular vehicles and liquidity provisions are brought into acute focus by investors. So just a question to you, Kerry, in particular. Could you just share some of the key data points that you see within the private credit space that we need to be watching out for? Any potential dislocations? And how should investors be capturing the opportunities within private credit?
I don't think there's a conversation that I have with a client that doesn't at some way talk about private credit or have some angle back to our private credit, whether it's AI and the software as a service theme, or just all the headlines that you see around gating of funds and what's out there. I think there's obviously driving a certain sentiment towards the asset class, but it's important to realize that, yes, there are these things that we should be aware of in terms of those risks, but that's how manageable they are. And I think one of the concerns that a lot of investors have when it comes to this is that this is an asset class that's grown very quickly. It hasn't been tested by a downturn. We're not sure about how it's actually going to perform. And then, therefore, seeing perhaps the downside risk to that. I would argue that there's a case for thinking around the reason why private credit has grown so fast and the role it fulfills in an economy in terms of lending and actually financing out there. So a couple of things to provide some background on this, James. I think the first is the context around what it does in an economy. So when regulation was increasing, banks were stepping back from lending in terms of this part of the market. You saw them move away from broadly syndicated lending as they had to have greater capital requirements that the regulatory environment made them have. And so a lot more of the market was looking for lending that came through on this private credit channel. And more recently, you've seen some of those regulations relax. You've seen banks come back in. And so a little bit more balance between private credit and broadly syndicated lending, not to the degree it was in the past, but coming back a little bit. And I think this is, again, a realization that there's different parts of the market that these serve. So very large lending, you typically go to a broadly syndicated, you'll go through the banks, they'll go and place those loans in the market to different institutions, and they will do it at a very large scale. If you're a smaller company, that doesn't really work for you, and people aren't going to probably want to buy your debt. So that's where the private credit fulfills that role. It's going to fill this area around the smaller part or the middle market part of the lending. So it's always going to have a place in the economy. So this is not the end of private credit. It's not the death of private credit that you sometimes read about in terms of the negative headlines coming through. The second thing I point out is the size of what we're talking about, and just some context to this. So the chart on the right just shows you the size of lending markets. So investment grade, you've got $14.5 trillion almost there in terms of US dollars of outstanding, basically, investment grade loans. High yield at about $3 trillion, obviously much smaller, but very significant. And then you've got private credit, and the definition can change, but the one we're using here ends up with about $2.2 trillion. Now, it's not all private credit, because private credit captures lots of different aspects. So you've got direct lending, you've got BDCs. So even the bit that's in focus now is this bar on the far side, this sort of $500 billion that's in private business development companies or PBCs. There's obviously a public traded part of that at the moment, which is doing quite poorly when you look at the valuations of it on the market. But this is a very small part of what we think about in terms of the total lending that happens in the economy. And so when we come back to that, is this a systemic risk? Probably not, because the exposures are just very little when you think about what banks hold, what insurance companies hold. And so we don't think about it being anywhere near like, subprime and CLOs and what happened with those. So collateralized debt obligations. So it's a very different beast than it was in the past. The second thing is that, yes, there is a high level of software exposure. It is there. The chart on the right is one way of measuring it. On the left, the pie chart. And it just shows you, this is an average over the last 5 years. By lending globally, it's a pretty high weight there towards software. You could even argue with some of the other sectors like healthcare, probably a lot of that is software that goes into healthcare. The way that it's recorded and defined can vary because you're relying on the people who do the loans to define them in the right way. And so there is this hefty exposure. So again, it's about the context. Not all of those loans are going to be ones that come under threat from software as a service and the AI disruption. Some of them probably sit high enough in the capital stack that they've got a senior secured basis to them. They're probably okay. Not all of them will have light covenants or lower levels of standards around underwriting associated with them. But there is going to be some fallout. There is going to be loans that don't perform, and I think this does come back to an understanding of your own manager, who you're going with, what they actually do own, and the exposures they do have. And so I think what this a lot of will drive is not necessarily wholesale bad performance across the sector, but you're likely to get a much wider dispersion in private credit managers than perhaps you've seen in the past because of this. And it will take time for this to play through as these loan matures, as you see renegotiated. So I think it's going to be with us for a little while. It doesn't change our view about the role that private credit plays in the economy and lending, and the role that it can play in a portfolio as a source of income, because we think it's going to be relatively persistent in what it does. Now, on that income has come down a little bit. So obviously the orange line here is private credit. This is through the end of March. You can see that line in yields has come down to about 9%. It's still pretty decent above the cash rate. So you're getting a pretty healthy spread above that for generating that income. And you've seen those yields start to rise in leverage loans and in the high yield bond space, reflecting some of that risk that's out there in the market around the macro side of things, where private credit, the way it's marked, is not really capturing that at the moment. So in terms of that risk reward trade-off, that's something to consider when you think about the income generation versus those underlying risks that comes through, but also a realization that when it comes to some of those arguments around liquidity and the redemptions and the trouble that investors perhaps perceive they have about getting their capital back, there are ways that private credit managers can manage that through either the fact that they're getting interest payments off these underlying loans all the time, the fact that they can think about the repayments that are coming through and they can eventually pay those back. There's the notion that, again, there's income that's coming through that provides that liquidity. And they do have these rules around the gating, whether it's the 5% quarterly redemption request or the 7%, there's a bit of flexibility in it, depending on who you look at. That's there to protect the investors in the funds that don't want to take their money out. They don't want to have suddenly forced sales that depreciate the assets that they own to really have that much greater negative effect. And if you look at who owns private credit, by and large, it's institutions. It's not retail or wholesale investors. It's the retail institutions that dominate, and they have a very different investment horizon in terms of their longer term nature, whether it's matching liabilities, or thinking about how they want to put capital work, or their comfort with having more illiquid assets in their portfolios given their time horizon. That is not changing. It's that sort of movement around the sort of wholesale investor, which is relatively new. And again, for us, that sort of reinforces some of the idea around why you might not see this massive movement away, or this end of private credit as a viable asset in a portfolio. However, James, there is a but sometimes. It is worth noting that there are things we want to watch. There are things out there that we can't say is everything is rosy and everything is great. And this is why the guide to alternatives is great, because we can use it to track this data. We can follow it and see how it progresses. And I've got to say at the moment, and there's a lag with this data when it comes to alternatives, there's not too many things there that are really flashing red. There's some amber warnings when it comes out to some of the fundamentals, but there's nothing that's screaming red at us in terms of the risks out there. You can see that default rates on the left-hand side for private credit, not too dissimilar to leveraged loans and high-yield bonds. We haven't seen that big pickup just yet. You can look at the leveraged loan default activity in the bottom right. Here we're splitting out distressed exchanges and leveraged loans versus the underlying default rate. That's important because a non-payment of interest or a coupon or a principal leads to a distressed exchange in the levered loan space. So it captures a broader array of stress, and that has widened, but it's not excessive. It's, coming in a little bit at the moment. So there's pressures are there, but they're not outstanding. And there's that flexibility that comes with this. So there's obviously the ability to renegotiate those loans should there be that stress. There's the ability to inject more equity should there be that stress. So it's very different to the public bond market where a default is a default. But the thing we do watch closely is this payment in kind. So payment in kind of payment is basically when a lender can't make those interest payments. They get added to the end of the loan in terms of the principal that has to be paid back, and kind of deferral of the cash flows out there to support it. Now, these are good and bad. Sometimes that those terms are built into the original lending agreement, and so you'd say that's transparent and visible and shouldn't be seen as a negative. Sometimes they're added later, and that's the ones that are probably more concerning, where you see the need to have this extension to those payments added in that weren't originally in the terms of the lending, and that's where we start to worry about the stress. And as that number has gone up, that's overall payment in kind. A little bit more of it is that sort of bad payment in kind that we want to monitor, and that's why we talk about that sort of yellow, sort of amber light on this to a degree. But again, I would stress that none of this is sending a very negative signal. Those non-accruals, those payment in kinds, are sending a directional signal, but not one that indicates outright stress right now. And so it's something we monitor and we watch in terms of thinking about, are these fundamentals really changing against what is a relatively constructive view for an asset class that we think has some permanency in terms of what it fulfills in the financing market.
Yeah, thanks for that, Kerry. So simply put, we see the place for private credit in a well-diversified portfolio. We see it as being additive to income streams and diversifying income streams from traditional public fixed income, being very complementary to the public asset class. Correlation might be a little bit higher, obviously, to public fixed income, but the differentiated income can be additive to a portfolio. And going back to the AID analogy, your private equity and private credit, as we've spoken to so far, can play very different roles, but the way in which we particularly like to think about approaching them is through that secondary space. And at the advent of our J series that we're launching, a series of strategies around private equity and potentially others, we're going to see that secondaries focus come through. Now let's turn our attention, Kerry, to an asset class within alts that I think has really had a lot of attention over the last 18 months, and for good reason, which is hedge funds. Hedge funds are widely seen as tools that provide diversification, provide ballast to a traditional portfolio, and provide a differentiated alpha and return stream that I think investors are longing for when volatility rises. Hedge funds at the same time are fairly difficult to access up to now. And I think when you think about the role of hedge funds in a portfolio, you think about the ability of hedge funds to withstand, really volatile markets, but also fundamental regime change within markets. And I think if you're an investor, particularly within the mass affluent space, you want to think about other options than just adding to bonds to bring you diversification. This is one way that you can add to diversification. What you don't want to do by adding hedge funds to your portfolio is just simply adding a bundle of repackaged equity beta. that doesn't help from a portfolio correlation perspective. And so what we've got to really think about is what are the challenges of holding hedge funds. We know that dispersion can be quite wide. We know that the difference between best and worst in different categories is something to consider. And as I alluded to about alts as a whole, not every asset class behaves in the same way. It's also true specifically within hedge funds. Across the different styles of hedge funds, we need to think about them slightly differently. So question to you, Kerry, is can you just walk us through how hedge funds are being used historically during periods of diversification need? Particularly that refers to equity drawdowns or rate shocks. But what conditions need to be true for them to work?
I mean, yeah, I think it's in the name, right? Hedge. They're there to try and add that diversification or take advantage of dislocations. We often think about hedge funds as being like the most active of active investors, being able to position very quickly across markets to take advantage of those dislocations as they do appear. And I think there's some great charts that we have from the Guide to Alternatives that kind of illustrate why they have and haven't worked in the past and their benefit in terms of thinking around that diversification elements to it, James. So this chart just shows you the correlation between hedge funds and a 60-40 portfolio during times of stress. And so you can see that those circled areas of when we've had those big drawdowns in the market and the fact that that correlation to the hedge funds has been negative means that they've provided that diversification. More recently, if we look at Liberation Day and thinking about where the correlations are at the moment, it hasn't been as negative. Some of that's due to a lot of momentum in the equity market in terms of what we're seeing, which has been a challenge for some hedge fund strategies. But I would make the point that even if you look at the end of that chart, it's 0.2. That is virtually no correlation. So you think about 0.2 to negative 0.2 as correlation being pretty much none. So even an asset class that has zero correlation still diversifies your portfolio. You make the same argument for bonds, right? The correlation is not nearly as beneficial as it was in the past. It was negative, but even at zero, it still diversifies to a degree, but it's not the only thing you need. You need these other ones, such as hedge funds, to try and add to that diversification to build that robust portfolio and also think about, the upside that they can deliver in terms of what they do. So, I wouldn't sort of write them off and just in terms of that correlation being a little bit higher. It's still actually very low historically. It still provides that diversification benefit. And that short-term challenge with some of the markets, I think, is very different to what we've seen in terms of the tailwinds that we now see building in terms of some of the structural changes that are out there that could be much more supportive for hedge funds overall. And so this chart, new to the Guide to Alternatives this quarter, really tries to capture the three things that we think are important when thinking about the challenges and the opportunities that are now presenting themselves in the hedge fund space, what really drives them. So we're thinking about the cash rates. So hedge funds hold a lot of cash-like equivalents and cash is collateral. So a higher cash rate generally leads to a better base starting point for thinking about your return from your hedge fund. There's another chart in the Guide to Alternatives that demonstrates that. We're looking at different regimes for cash rates and the hedge fund returns. But you can see here that, prior to the GFC, on average, we had this light blue period, that dashed line there, much higher cash rate. We then dropped down to that idea around very, very low cash rates. That was that new normal period where we couldn't have inflation, we didn't have any positive real cash rates. And then now we're entering again, as I mentioned, that sort of regime shift, which suggests higher inflation or inflation that's at or above targets for central banks. And so you get a higher cash rate. So first positive, thinking about hedge fund performance going forward. The second one is about that volatility in the market. Again, you can see these three distinct periods where you had average rates of equity volatility that were higher prior to the GFC. And then when we had the advent of just excessive liquidity being pumped into the market around QE, that sort of drove asset classes and everything went up. You didn't have that sort of dispersion and that volatility in the market. In fact, you had a VIX level that was at very, very low levels for a very long time. And so that volatility to enable that trading within hedge funds to take advantage wasn't there. And then suddenly we're going back up into this more, what I would class as episodic volatility that we experience, these very strong spikes in the VIX index. And that is creating more opportunity for thinking about and a better regime of not uncomfortable volatility, but back to those volatility levels that we'd see prior to the GFC in terms of how we think about when hedge funds did really well. And then finally, dispersion and valuation. So you need to have a spread between those that are doing well and those that aren't to find those mispricing opportunities that allow for that growth to come through in terms of that return potential. And again, all that excess liquidity, all that QE just meant everything did well. Money flowed back into the market, and you can see that sort of 2010 to 2019 period where you had all that, there was just not a lot of valuation dispersion. Where if you look at the market today, because you've got mega caps that are doing very well, and the rest of the market being left behind, if you look at the dispersion on the valuation in terms of that spread between the bottom 20, the top 20, and the bottom 80 percentile coming through, there's a chart in the guide to alternatives that shows this, guide to alts that shows you this, obviously. That really does show that dispersion has widened out, and that creates a lot more opportunities for hedge funds to take advantage of that and be much more active overall. So I think this is a better setup for thinking about the view from here from hedge funds, even though the performance has been a little bit challenged in the very short term. And again, you can see this here in terms of the first quarter performance from hedge funds. I mean, this does come back to the diversification point we make across asset classes. It can be challenging to pick which of these strategies is going to do well from one year to the next. And so you have the same ability to choose something that's more like this. Here we're using Pivotal Path Composite Hedge Fund, but a diversified bucket of hedge funds to try and smooth out that journey in terms of thinking about the benefits, in terms of what they can add to a portfolio, but also the diversification within a portfolio. So there is a better setup case for hedge funds from here, but I would, as you said, James, make the point that managed selection is key, as it is in all asset classes, and you can see the very wide performance dispersion across different strategies for managers overall. So due diligence, picking the right manager, having confidence in them, all exceptionally important when we think about which hedge fund strategies to go towards.
Yeah, absolutely. The dispersion across those subsectors of hedge funds is quite stark, isn't it? So the case for a diversified pod of hedge fund managers is crucial. But they do, I think, play as an asset class a real good diversification role, adds ballast to a traditional 60-40 plus as we think about the alt allocation. I think is probably a very strong case for hedge funds as we look out over the next period of quarters. So let's round it out, Kerry, with the final asset class on our little journey around the asset classes, which is infrastructure. Now, for many, infrastructure may need a little bit of explaining in the sense that it isn't, in a traditional sense, an asset class that many have had exposure to over the investable universe or periods of time. And now, more than ever before, it's being recognized as a very stable and consistent income generator. Again, on the subject earlier of diversifying income streams, infrastructure by its very nature is perhaps a slightly more predictable asset class. And we're going to talk about why that is. If you think about how to generate durable income, you think about assets that are in really, really core industries and segments that are just, I think, the spine of the global economy. So maybe a little bit less disposed to consumer discretionary or volatility in consumer spending, and perhaps a little bit more geared towards the global economy and its core functioning. So we're going to think about infrastructure in that sense for those of our listeners who are a little bit less well attuned with the opportunity within infrastructure. But infrastructure also needs to be picked apart. We think about infrastructure, about movable infrastructure, landed infrastructure, and the various sub-economies and themes that it relates to, thinking about things like power generation, water supply. These are very, very core industries that I think also therefore offer ballast and consistency of income potentially to be derived from it. So question to you, Kerry, is as you break down those infrastructure returns and income streams, what are we really getting as investors? Is it income? Is it capital appreciation? And which secular trends are we really dialing into over the next few years as it relates to infrastructure investing?
I mean, it's such a good question, James, and it's come up. And if you look at the fundraising for alternatives so far, a lot of it's going into infrastructure because of some of these big themes, which we'll talk about, but also because of that income demand. I mean, it's very much like a fixed income or a bond in a portfolio, and the function it plays. It's giving that really steady income. It's providing that diversification benefit. So sort of a longish duration asset, if you want to put it that way. And so this chart really breaks it down. The gray is the income that you get, and this is just using the MSCI Global Private Index in terms of infrastructure, not a fund or anything like that. But you can see that gray portion is that steady income that you get regardless if there's a capital drawdown. So 2021, 2020, you saw the capital float down. That was a bit of an exception if we look at this chart. But it's that income stream that people are really after. They want that consistent income that maybe they can't find in the public bond market, or a bit hesitant to add to bonds given some of those inflation concerns, because infrastructure has an inflation hedging quality to it. And also they want to focus on those things that, as you rightly mentioned, and I'll pick up on, a core to the operation of the global economy, and core in terms of how people spend money. So the box there shows the breakdown of what's in this infrastructure index. So it's power, it's transport, it's communication, it's water, just things we need to live our lives and for the global economy to operate any given day. So less sensitive to GDP, less sensitive to some of these geopolitical risks and these shocks that come through. And in fact, as I'll go on to, has been enhanced in some degree by what we're seeing from this geopolitical conflict, because of that power and electricity component, that energy security that's becoming so crucial when we think about parts of the world, and how that plays through. So jumping forward a little bit and just shows you that global energy trends, when we think about what's happening in the US, they've become a net exporter of oil and energy because they allow that, natural gas and oil. They've had a bit of a shift in terms of that over the last few years, but Europe still demands a huge amount of energy from the rest of the world. They're also spending the most in terms of thinking around that energy security, given they've experienced what was very much on their doorstep with the Ukraine-Russia conflict, and trying to build out a more reliable energy infrastructure for their economy, mainly through renewables and solar. So a huge focus on this electrification, this energy security, and energy independence, which often means local energy and means renewable energy coming through. And I think on the bar chart on the right-hand side, you can see how that same thing plays out across many parts of the world, where there's still a heavy reliance on oil. So South Korea, for example, Japan, Australia, or even on coal, when you think about some of those objectives around moving towards lower emission standards coming through. So the first thing that's really driving this demand is that build out that's still very much there around these energy security and energy reliance or resilience themes that are coming through. The second one that's obviously very important is obviously the demand that's coming from AI, and what has proven to be something that's very inelastic. No matter how much demand we're seeing there come through, the price of these chips and everything still keeps going up, and the hyperscalers are willing to pay it because they see the potential in terms of the need for all those compute power, that inference, that data center build out, to satisfy demand they see from the end consumer, the businesses that will incorporate these new models into their business practices from consumers. And so that data center capacity forecast on the left-hand side, you can see how much of it's been driven by AI out to 2030. Or if you look at the bottom right-hand chart, that electricity consumption from data centers in the US as a share of total demand, I mean, it's going up to 12%. These are big numbers. Like the chart on the left-hand side is in gigawatts, and it's going from 103 in 2026 to an estimate of more than double, 219 by 2030. And for context, one nuclear reactor produces 1 gigawatt. And so you've got 100 gigawatts of expected energy need over the next 5 years. And so that means you need 100 nuclear reactors. A nuclear power plant might have 4 reactors in it, it'll say, or maybe 5, but that's the scale in terms of the build out and the need for this electricity. And again, that feeds so much into thinking about what we're seeing in the infrastructure space, from that electrification, from that security and that transition in terms of renewables that's coming through in a big way. And finally, I'll just touch on the inflation protecting nature of this. If you think about the regulated utilities, they have the ability to pass on the costs to their end consumers from those higher prices, the cost of that build out from that grid to supply that energy. And you can see the scatter plot on the right-hand side just shows you the level of inflation. The left-hand side vertical axis just shows you the return on the equity. And as you get more inflation, you're allowed to return more equity to your shareholders. And so you get that pass-through from the inflationary impact. And that inflation in the US has been running above normal levels of inflation for electricity. So the blue line, electricity, above the gray line, because of the cost of that build out of the grid. And so it creates income for your portfolio, it diversifies, and it's an inflation hedge. So that's why we're seeing so much demand on the infrastructure side that's there as we think about how this is, again, a very long-term shift that really captures some of those bigger themes we've seen around geopolitical conflict, shift to renewables, the shift to being much more resilient when it comes to energy overall. So I think, again, it's fundamentally something that's more appealing in portfolios as investors look for that income stream or that diversification benefit.
Yeah, there's so many compelling reasons to be thinking about infrastructure as an asset class, but none less so than I personally think it's the super themes that this asset class is subject to. One you touched on, and just to allude a little bit further, so the reshoring of energy as it relates to energy defense and energy security as nations prepare for a world of like heightened geopolitics is a key crucial theme that we're seeing as a global real conundrum to solve for, but particularly in recent times, we're seeing that become additive to the fact that there is just an energy shortfall in outright terms, particularly the grid that's going to power the electrification of our lives in and among the AI super theme that we're all witnessing take shape as well. So many structural drivers. As we think about the role in the portfolio, we can't think how important this would be. If you think about the predictability of income, infrastructure is probably the asset class that would give you the most cushion and shield, especially for those investors that are duration sensitive, worried about the potential direction of rates or the speed of the change of the direction of rates. This is one particular asset class that could provide income, but also income consistency. And that's why we're presenting it as a really unique investment opportunity, and one that's become more investable to investors across the wealth continuum in recent times with the advent of different asset classes such as transport and others. So we're taking a little journey there around all of the sub-asset classes of alts, Kerry. I think each and every one of them have their own, pros and cons as it relates to portfolio building. Some are additive to alpha, some are additive to income, some provide diversification. But I think the message we'd like our listeners to take away is actually a combination of those different alternative sleeves can be super additive to a multi-asset portfolio or an alt bucket on its own. Kerry, thank you so much for joining us this morning and taking us through the Guide to Alternatives. That's a resource that's publicly available. We look forward to sharing that with you. And we'll come back in the next quarter with more insights around alternatives. And thank you again once more for joining with us. We'll end it there. Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.